2013-2014 work plan. Chris, would you like to?
Thanks, Terry. Obviously, we don't have everybody's input, but I'm going to encourage you to, the three of you that are here, to hand these in afterwards if you can, or email them to me. Harry, the same thing. We would formulate how you want to schedule your next year's objectives. I listed several different options here on the page that we've looked at in the past. You told me at the last meeting you wanted to do a deep dive into the global equity portfolio, specifically the debate about active passive in the U.S., which we will start in a few minutes here, but then continue on in the fall of next fiscal year. But that still does leave an option open for some subjects to be delved into in the springtime. And if I could turn to Paul. Paul Rosenthal had a specific issue he thought he wanted the board members to think about, which really gets into our cash flow and trying to match the liabilities.
Yeah. Here, Paul. I'm sorry. Just a second, I'll clear the floor.
Should have warned you, Terry, sorry.
There you go. All right.
Yeah, there we go. Yeah, I and maybe I'm not going to explain this perhaps as well as I've thought it out, but I think we look at investments that we're investing because we have obligations we have to pay, and I know that there are asset liability matching or investment immunization strategies that have been that are used in some cases. The argument that essentially we're providing an annuity, and a company that provides annuities, invests specifically for the obligations that they have to pay. This is probably, they tend to do that with fixed income investments. This is probably not the time to be doing that, given the market today. But on the other hand, I think it's a factor in how we should maybe be thinking about investments, and an alternative way to look at them. And so that was my idea, was to learn a little bit about that, knowing that is an investment approach which does have legitimacy, is used in a lot of places, and maybe even if we're not thinking about adopting it, we should understand whether it should be part of our investment strategy. A few years ago, when there were the Build America bonds, which were taxable municipal bonds, I think the question at that point could have arisen, gee, if we can get 30 years AAA rated bonds that yielded 6.5% or 7%, should we have done some of that? And I know that we did some, but it was a pretty small amount. So that's the question. It may not be that relevant in today's interest rate environment, but on the other hand, it might be a useful educational discussion as to sort of investment strategy for the board to consider.
Yeah, so I would encourage the board, when you look at that list, add one under other. Let's call it sort of cash flow focused or cash flow linked investments. It's not pure LDI, because we've looked at that, but it would be, I think what you're describing is if you could buy a 7.5% or close to that cash flow and lock it away, wouldn't that help the system? So we could look at the match between the cash flow and the liabilities and investment options. So factor that in as another option to consider. What I do is take all these weightings, similar to what the prior presentation, and we'll come back to you. It will be part of the retirement board agenda in July, presented by Harry showing you here's what you as a committee wanted to focus on, and so here's the key objectives for next fiscal year.
Is that all?
That's it.
Any other comments or questions? Harry, do you have a comment?
No, Terry, thanks.
Okay. Let's move on to item 13, the 2012 to 2013 Corporate Governance Engagement Plan.
And up comes the corporate governance staff. Anne had to step away for another board that she's on and attend. But Aisha Mastiani, Mastagni, I was close. Should have practiced it. Want to highlight Aisha was named last year and this year one of the 40 top investment officers under 40 years old. And then Brian Rice, who's close to 40 years old, but would be one of the top 40. You're welcome, Brian. Give me $5. You're a portfolio manager in corporate governance. So if you have any questions about any of these companies that we're engaging in the activities, please feel free.
Good afternoon, everybody. Traditionally, this item has allowed the governance staff to give an update to the board on the progress of shareholder proposals that we filed during the current fiscal year. This year, we wanted to expand the item a bit to certainly give you the information on the proposals, but to provide you with some additional color on the engagements that we're doing on our signature issues. So, for example, Aisha is working very hard on executive compensation. We have no proposals this year on executive compensation, so we didn't want to give the impression that nothing was being done. So we've certainly been very busy. I think that's evidenced by the approximate 75 proposals that are listed in attachment 2 to this item, and I certainly think we've been very successful, as evidenced by the approximate 70% withdrawal rate on those proposals. So we're here to answer any questions that you might have.
Okay. Any questions? Seeing none, thank you very much. It's an excellent report. You folks are busy.
Thank you.
Very busy. I know it. All right. I think it's time for our passive versus active management panel. And
David's going to come up with everybody and introduce them. And the one thing I want to say, we wanted to make this entertaining. David is going to play the role, as I say, of interviewer, interrogator, because the point of this is to really draw out our initial discussion of active and passive management. Each of these people feel strongly about one aspect, and I think our hope is you'll get a couple of takeaways of interesting points to learn and think about as we make future decisions. David.
Great, thank you, Chris. Good afternoon. So as we approach this topic, we wanted to really look at the experience that CalSTRS has investing in both passive and active, not only over the years, but over the decades. And we wanted to pick some managers who've been through the highs and the lows with us. So we specifically didn't pick, who's performing best as of, a certain period, but said ones we've had challenging conversations with and discussions, and also ones who have done really well for you. So we have a panel here who really represents the real world of CalSTRS investing, and they have thick skins and they're ready to hear all the questions that we're going to present to them today. And what I'll do is I'll just introduce them, let them briefly introduce who they are, and talk a little bit about the relationship they've had with CalSTRS, and then we'll dive right into the questions. So I'll start with John Perrone, and he is from BlackRock. And John, I'll let you sort of give your introduction.
Sure, thanks very much. So I'm representing the passive side of the fence today, that BlackRock since 1998 has managed passive assets for CalSTRS, and in particular in both domestic equity space. We manage about $12 billion, and is also in international equity space, manage on the order of $6 billion. We actually also have some assets in both enhanced indexing, about $500 million, in a Pacific Basin active mandate of about $1 billion. But the preponderance, about 95% of the money that we manage, is in passive. And again, that's what I'm going to represent today.
Thanks, Tom. And next is Max Darnell from First Quadrant.
There we go. Good afternoon. I am Max Darnell from First Quadrant. I am the managing partner and chief investment officer for First Quadrant. We are a asset allocation shop. And by that, I mean that in the traditional ways that you'd think of us doing asset allocation, we do things like global tactical asset allocation, we manage currency, we do a lot of things that classically sound like macro. What we do for you is run an equity portfolio, though, and I would say the same thing about what we do in the equity space, which is that we do asset allocation. Most people in that space are really bottom-up stock pickers. They're looking at they're looking at the trees, if you will. We're really looking more at the forest. And now what we're trying to do is we're trying to allocate on an active basis to different types of risk factors that we see present in the marketplace. Now, to do that right, we also have to get the bottom up right as well. So we do focus on bottom up to make sure that we get our top down choices implemented correctly, and we add a little bit of value in doing that. I was intrigued with some of the notes in preparation for this, the comment about the fact that, or the focus on the fact that, you know, good managers go through difficult periods and good periods. We've done very well for you in the 15 years that we've been running money for you in large cap U.S. equities. But I would note that when we started with you, we started at one of the worst possible times, right at the end of the beginning of the end of the tech bubble. We're on the wrong side of that in the beginning of that. You guys stuck with us, and it's been very rewarding since as a result. So that's what we do for you.
Thanks, Max. Next is Scott Black from Delphi.
Good afternoon, and thank you for inviting me. I'm Scott Black. I'm president of Delphi Management in Boston, and we run a small mid-cap fund. We started in February of 1999, and essentially we're a deep value player in the style of Warren Buffett and Benjamin Graham. We're active managers. It's on a bottom-up basis. And unlike a lot of people that buy stocks and pieces of paper, we're from the Warren School, where you buy the business that has high return on equity, strong free cash flow. But what differentiates us from other people, we buy it at absolutely low price to earnings ratios or price to liquidating values. We do no market timing. It's strictly a bottom-up type of philosophy. And we run at this point about $650 million. Initially, we were told to buy in the Russell 2000 value up to the 2500 values. That normal capitalization range is about 10, 11 billion in today's market. And we were given flexibility about 2 years ago to expand to the all-cap universe of value. But at this point, the balance is approximately 50% in small mid-cap and roughly 50% in larger caps.
And finally, Tina Biles-Williams from FIS.
Good afternoon. Good afternoon. Thank you for having me. I'm Tina Biles-Williams. I'm the founder and CIO of FIS Group, an investment advisory firm based in Philadelphia. We have been distinctly privileged to be part of CalSTRS Development Manager portfolio since April of 2004. And over the years, through a combination of cap adds and investment return, we're pleased to note that the allocation today is over 4 times what it was initially. So I want to thank you for that. We're here because we believe that though there's a clear pattern of cyclicality in the relative performance of active managers, if one can identify skilled managers and therefore hold talent equal, smaller AUM managers, or what we refer to as entrepreneurial managers, have a structural return advantage over their larger peers among some strategies. We're also here because during the 5-year post-financial crash period, the various cyclical and structural market dynamics have frankly challenged that very thesis. particularly among large cap managers, U.S. equity managers. A research paper, which is included in your board material by your very able staff, entitled Is Active Management Alpha? On Permanent or Temporary Disability, was our attempt to identify the factors driving recent performance trends and to determine whether they represent a new normal or an aberration. So I look forward to exploring these issues with you and with my fellow panelists.
Thank you, all of your panelists. So John, as the passive representative here today, we're going to let you lead off, and maybe you'll sort of set such a established and research and data-oriented discussion that they'll be behind the 8 ball all day, and they'll be scrambling to catch up to you. So lead us off.
Okay. Yeah, thanks very much. So in terms of introductory remarks, I'm really going to focus on 3 different things. Brief development of kind of the theoretical case for passive management. To your point, we'll delve a bit into the empirics in terms of historically how, specifically in domestic equity space, have active managers fared relative to passive. And then thirdly, I want to make some remarks specific to CalSTRS that, in some of the, we saw this in some of the earlier remarks that you guys have $165 billion. You have 55% allocated to global equity. So that's $90 billion. Let's say half that is in U.S. equity, roughly. So $45 billion. Is there a limit in terms of how you can put that money to work actively? Can you spread that money around to enough good managers to make it worthwhile? Okay, so kind of those 3 points. So on the theoretical side, that we have to remember that there's a fundamental law of gravity we're dealing with here, and that is that collectively across managers, there's a zero-sum game. Okay, so for each active manager that, say, is overweighting a particular security, there's somebody on the other side of the trade. And I think probably the best exposition of that, or the most succinct exposition of that concept, was developed by William Sharpe back in 1991. He wrote a paper entitled The Arithmetic of Active Management. And to summarize, basically he made the observation that the combination of active managers and passive managers intrinsically is going to define the investment universe of the market. Okay? And the passive managers, by definition, will essentially be getting the return of the market. So what that means is we have this other piece, the active collectively, the average actively managed dollar before fees and costs, by definition, this is a tautology, if you will, essentially has to sum to the return of the market. Okay, and there's nothing in there embedded about the concept of market efficiency and market inefficiency. That's just a logical relation. Okay, but what we know in practice, right, is that we think about things like management fees, turnover. Those things are going to be significantly higher for active managers than passive managers. So that the upshot is that in aggregate, and again I'm speaking in aggregate, that we would expect active managers as a group to underperform passive managers over a long time horizon. Okay, so that's a theory. Okay, so now what I want to do is let's examine some actual real life data. Okay, and again, in the context of focusing on domestic equity universe, that Standard & Poor's Dow Jones, they have a study that comes out every year. It's called the SPIVA study. So you think of it as comparing indexes and active. It's a scorecard. Okay, and so this study has been done every year for the past 10 years, from 2003 to 2012. It looks at over 3,000 active funds across all capitalization buckets, so large cap, mid cap, small cap in the United States. And if you look over the past 10 years, the findings are pretty stark. I would suggest that in large cap space, 60% of active managers have underperformed the benchmark. Mid cap space, 62% have underperformed the mid cap benchmark. And in small cap space, 65% of small cap active managers have underperformed small cap benchmark. Now, there's obviously a variety of ways you could cut this data looking over 1, 3, 5 years, and I imagine that will be part of the secondary part of the debate given your introduction there. But again, what are the ramifications of that? I'd say the practical ramifications are that investors are moving with their feet. If you think about in the United States, what is the average institutional allocation to equity, to indexing in equity? It's 35%. If we kind of drill down and start thinking about what about an institutional defined benefit space for U.S. equity, the fraction of indexing goes up to 50%. And then to obviously link it into your all's case, that you guys are actually 70% index and 30% active. And so, like I said, we've seen there's certainly been a secular trend over the past 5 years in terms of increasing relative allocation to indexing in domestic equity space. Okay, so I think in aggregate, I think there's a compelling argument that if you're just picking random active managers, you're far better off being in indexing. Okay, that now that obviously each of the active managers is going to talk to some extent about why he or she is especially skillful, right? And that's going to be the reason why you should have active management as opposed to passive management. But I just want to kind of put a caveat there that at the end of the day, you as the plan sponsor have to have skill in picking who those good managers are ahead of time. So there's 2 dimensions of skill. One dimension is that they're good active managers out there, okay? And even if we were to concede the first point, the onus is still on the investment staff and consultant to have the ability to pick ahead of time who those good managers are. And obviously, past performance is not necessarily going to be indicative of future performance. There's obviously a myriad of factors, which I'm sure we'll flesh out over the course of the conversation, which go into that decision. Okay, and then again, the third thing I wanted to mention, again, we said that, okay, you guys have $45 billion to invest in U.S. equities, at least as in the context of your all's current asset allocation. That begs the question, how many really good managers can you find out there? And also, how much money are you comfortable investing in them? So, say you find 5 great managers. Are you going to put $9 billion of your portfolio in each of those managers? I would argue probably not. So that I would advocate for, prudence. If you do dip your toe into active management, you have to be very cognizant of the risks you're taking and the probability of possibly underperforming the benchmark. One last comment. I think there's an asymmetry, if you will. There's also an asymmetry in asset allocation, right? When you outperform your 7.5% bogey, you get the pat on the back, great job. But when you turn in a subpar number, right? That's when things they hit the fan. I was struggling for a word there, if you will. But the point being, you have the exact same situation in alpha space in terms of active-passive decision as you do in the beta space, in the sense that, okay, say we went out and picked a set of managers and they outperformed the benchmark by 0.5% collectively or something of that ilk. Okay, that's great. Good job. But then on the flip side, I would argue that the pain you feel, both politically and otherwise, from, say, picking a cohort of managers that underperforms by the same percent is worse. Because there's always the backdrop question is like, hey, I could have cleanly implemented my strategic asset allocation policy essentially for nothing by hiring index funds. So what are you guys going out playing this game where we know it's filled with potholes and challenges? You know, so again, I would say that the starting point is passive, and then it's kind of y'all knock me off the perch, I guess. Thank you.
Okay, thanks, John. And by the way, here at CalSTRS, it's when stuff hits the fan. So anytime we're under 7.5%, the stuff hits the fan.
Okay.
Okay, Max. So you've heard John's sort of summary. I know you've read a lot of research on passive management. We all have. We know the statistics. There's a lot of statistics out there. Active management, just starting from square one, has a headwind. Why don't you tell us a little bit about how you maybe create a tailwind if you think you do?
It's a good thing you're sitting between John and I. No, thank you. So let me do this, if I may, just to start this off. So I want to build up a little bit more of a framework for this, for thinking about the active side of this, and really get into this issue as to, you know, how do you stand against the headwind. So first of all, the way that I look at this, and this is what I ultimately want to articulate to you in the next few minutes here, is the fact that I don't think it's really ultimately an argument about whether active management or passive management is better. I think the question is, in fact, simply how much active management do you want to have? Now that's a big statement. The passive side could easily say, well, no, it is an either-or type statement. So let me walk you through ultimately why I think that that's the case. First of all, we need to step back to a very high level here. Let's look at the marketplace as a whole. The reality is that the marketplace as a whole cannot function without active management. Price discovery is a necessary part of the marketplace, and unless you have people coming to the market with insights and judgments, you don't have a price discovery process. So active management is a given from the start. The question ultimately, as I say, then, is how much of it are we going to need? And there's a variety of other questions that I would pose. Now, just to drive this point home, imagine a market in which everybody tried to behave as though they were passive. Passive would mean, by definition, that we buy assets in proportion to which they are offered. That's what passive management would mean. That would mean that good firms would be very conservative about what they offer, hanging on to as much ownership as they can because they're profitable firms. Bad firms would offer a lot of ownership because they would like to sell an unprofitable entity to somebody else as much as they can. You need active management to prevent that sort of simple problem from occurring in the marketplace. So what are the questions here that really pertain then? How much you need to reach full efficiency in the marketplace? That's going to be a terribly, terribly difficult question to answer. We're not going to try to do that here. Second question is, do you need active management? So each of the individual investors needs to think through that question. Now here's the challenge in this. If others are engaging in the active management, you might like to make the assumption that, well, okay, that means that the market then has been made efficient for me, and I can simply follow along, save myself the costs. A few things that you really ought to think hard about in making that assumption. First of all, you can't assume that all the other participants in the marketplace are good actors. There are bad actors in the marketplace. How are you going to know when you're confronted with or trading with a bad actor in the marketplace? Think about, for example, the way in which several years ago it was big headline news about the way in which public pension funds had been getting fleeced by investment banks in their currency transactions. They were engaged in passive transactions with investment banks who were really taking significant advantage of them. How are you going to know that? You're going to have some insight and some ideas about what the right price is to be trading at to do that, and that is an active perspective on things. How do you avoid being a victim of the inefficiencies themselves? The market clearly has significant inefficiencies. I think we could see that in the macro level. We could see it in days like today, a dollar trading down 4% and quickly bouncing back up. That doesn't look like an efficient market. It looks like there are efficiencies at play. How are you going to make sure that you're not on the wrong side of those and that you're the one that all the rest of the sort of market efficiency creating active managers is profiting from. So some access to active management is really necessary for the proper management, especially of a firm, of a fund the size of CalSTRS fund, to make sure that we don't end up being the greater fool in the marketplace. Asset management means spending time, effort, money to develop an opinion, and the opinions don't come cheap. Whether that's internally developed or externally developed doesn't matter. The opinion needs to be cast. I would say that therefore, if you merely break even in the effort to engage in some active management, so break even after costs, that at least you have saved yourself from potentially costly mistakes, or at least you position yourself to possibly do that. Other questions that we may or may not be able to address, but just to lay them out, are, do superior asset managers exist? And I will have a few comments about that. If so, can they be identified? Which I think Tina in particular will speak to. And then very importantly, one of the most important points I want to make in this is, well, where should you go look for them? And I think some of the literature really helps point to the answer to that question. So let me just say a couple things about the literature itself. There's a lot of literature, there's a moderate amount of literature, I should say, about the active passive. I would say that the research is very good. The important thing, and I do empirical, and my firm does empirical research all the time. This is a lot of what we do on a daily basis. And the important thing in doing empirical research is understanding the difference between when the research has given you a conclusion versus when it has led to additional interesting new questions to pursue. And I think the state of the active-passive literature today is it has raised some very interesting questions, because the statistics that John cited, for example, really calls on us to dig in and say, well, wait a minute, why is this happening? But doing good empirical research means that you need to know when to ask why, and not to make an assumption about what just how far the research can be taken and interpreted. So first of all, I would say that the findings are not particularly surprising. What the findings generally point to is that when you've got a lot of hunters, or let's use fishers, you got a lot of fishermen out fishing the same fishing hole, guess what? There aren't going to be a lot of fish. And this is what consistently we see in the literature, is that where you find a lot of management taking place, that's where the inefficiencies seem to be most scarce. And you know, all the papers will tell you that large cap U.S. equities is the most difficult place to generate alpha. They will tell you that moving into the international markets, especially places like the emerging markets, are better and better places to be. Well, it's highly correlated with the number of active managers and the amount of historical experience they have. The literature will also tell us something else that's pretty obvious, which is that the larger the asset managers are, the less alpha they tend to generate. Well, there's a couple things that work there that might explain that, right? One is just a mere matter of incentives. Once you've built yourself up a very large business, your instincts might start to protect that more than to take risk with that, and dial down the risk and try to look like an active manager, continuing to charge active management fees. Large asset managers, or excuse me, active managers will suffer from market impact, so the game gets more difficult. And of course, they have defined their own fishing hole. So they're possibly overfishing their own fishing hole, and that's going to drive their alpha down. So those are some of the obvious questions that, or sort of observations that come out. But what about the important questions that come out of the literature? There's this, I think, very interesting insight that comes out of a paper that talks about something called the active share. I suspect you guys read about that. I think it was in your booklets. Why is the active share gone down in large cap equities? In other words, why is it that the amount of positions that active managers are holding in large cap equities, why has that shrunk through time? Is that possibly a reflection that the more managers that you bring in to play, that each marginal manager is probably that much less skilled than the other ones who are in the marketplace. So as you continue to bring more and more managers in the marketplace, you probably drive down the average skill level. There's also then, if you're not a skilled manager, there's an incentive to fake being an active manager. So the closet indexers, as we call them, are very present in these studies of the active manager space. So when we go out and we say, hey, how have the 3,000 managers in this space done? We're asking the question in a way that includes a lot of closet indexers in that, a lot of people who probably don't have as much skill. So we need to get at a deeper level here, and I think the issue here becomes one of chicken or egg. Is it that the space is more efficient and therefore people are acting more like closet indexers, or are we believing that the space is more efficient because we see a lot of closet indexers? So I think we can sort that out a little bit. So what really needs to be done is we need to be able to dig into these studies to a deeper level and be able to look at what are the types of managers in that space and try to understand something more meaningful than what we can see at the top level in these types of studies. You might find, for example, that those that are hunting, or let's again stay with the fishing example, those who are fishing in different ponds than everybody else, what we might find is that those are the ones who are doing well. Seems like an obvious hypothesis to throw at the data. Some examples here. I mentioned that one of the things we do is we look at equities from a top-down perspective. It's very different from what most people in the equity space do. So we're fishing in a pond that's not overly fished. There are lots of other types of examples of whether it's macro or currency or credit, you find these examples of people, they're just not doing what everybody else is doing. It seems to me that they would stand a better chance of finding alpha. And of course, there's a lesson for all of us in that, which is let's not go pick managers that are doing what everybody else is doing because they're probably not going to add much. So let me just sort of tie these comments back together and say that, ultimately, look, I think that the empirical research on this is really good and has really raised some good questions, but it hasn't really answered hasn't really brought us to a clear insight as to why the conclusion would be the case. We need to dig deeper to find out. I would say it's very important, secondly, to pay attention to where we're looking for alpha. So that is part of the answer to the question of, so how much of it should we have? And it's partly where should we go look for it in terms of active management. And then, lastly, it's very important to be engaged from an active perspective. I love funds such as CalSTRS that actually engage in active management in-house at the same time that they go outside, because they're having their own insights, their own ability to judge the effectiveness of managers outside, but also to learn about the various potential risks and inefficiencies in the marketplace themselves. And I think that's very important from an informational perspective for funds to have that. We just had a very interesting discussion about asset allocation a few minutes ago. I'll put this final point on this. You're making judgments. We may look at that as making a decision about a passive asset allocation decision, but it's not passive. It's passive because you're having to bring judgment and insight. It's an active decision about what you want to set your benchmark to be. And ultimately, it's unavoidable, therefore, to be purely passive in the investment management world.
Thanks, Max. I was trying to figure out where I was going to go with your fishing analogy, whether it was a long pole or a fast horse or something. So I'm glad you answered that you're just in a different pond, if you will. It really segues nicely into what Tina does. Unlike Scott and Max, they're really looking company by company, looking at whether it's a benchmark or looking at attractiveness of a business model. Tina's doing a lot of what we're trying to do, and that is she's trying to find those managers who are going to be able to find those companies that are going to be able to outperform that benchmark. So Tina, why don't you talk a little bit about what you do and why you think that your approach is going to be able to add alpha?
So I just wanted to add to what Max said. I mean, I agree with a number of his points, and particularly on the focus on active share. But so the question, despite the challenges of the last 4 or 5 years. The question is, what is the rationale to allocate assets to active equity managers, and in our case, to allocate assets to entrepreneurial managers? Prepared some slides, which I think someone will move as, oh, thanks, as I go along, because I think it just tells the story more easily. The first thing is the investment industry itself is consolidating. In 1991, the top largest asset managers managed about 21% of tax-exempt assets. Based on the P&I data, their largest money manager report at the end of 2012, that share jumped to 44%. And then the top 100 managers, the smallest of which managed $14.5 billion, managed 87% of tax-exempt assets. So there's clearly a great deal of consolidation going on. Just parenthetically, since I know CalSTRS has had a long and outstanding track record of promoting diversity throughout its organization, if one defines minority-owned as majority-owned by ethnic minorities or woman-owned as majority-owned by females, there are only 2 such firms on that 100 largest money manager list. So that's one thing. That's one trend. Secondly, if you think of assets consolidating among these firms, you have this backdrop of several independent studies that indicate that for particularly strategies based on fundamental stock selection, scale is actually not your friend in terms of performance. So you have consolidation and a number of studies. This particular one is from Vanguard, but there is certainly the more well-known one is a 2004 study called Does Fund Size Erode Performance? Next slide.
Gina, I have a question on that last slide. The first bullet point, is that only active managers or is it active and passive?
Both.
Both, okay.
Yes.
Thank you.
You're welcome. So the next slide looks at the relationship between active share, which the Petayisto and Kramer study demonstrated that with higher active share, quintiles tend to outperform net of fees. But the relationship between active share and assets, and as you can see there, the line slopes down, which means there's a negative relationship between active share and assets. So what it essentially says is that beyond certain thresholds, active managers tend to look more benchmark-like as beyond certain asset thresholds. The charts on the bottom compare the number of holdings between smaller managers, entrepreneurial managers, and larger managers. And the entrepreneurial are in the green, large are the blue, and you can see in most cases they have substantially more concentrated portfolio than their larger peers, which then engenders more active share. Next slide. These two are from the research paper I referenced, and they just simply support the Petayisto and Kramer study, which shows the positive. What I did was regress here active share for various equity mutual funds with information ratio on the left, excess return on the right over a 10-year period, and you can see that in both cases, there is a positive relationship between the two. So very consistent with the other study in your packet. Next slide. It's important to note that while we believe active share is important, difference does not necessarily mean you're skilled, right? It just means you're different. um, and so, and it also means that when there is a lot of variance of your holdings from the benchmark, that can engender a fair amount of return volatility, otherwise known as tracking error. So it's important to know sort of what you get with this concept of high active share. And therefore, selection, timing of either selection and deselection, and the measurement period over which you evaluate active managers, and particularly high active share managers, can significantly alter the results. Next slide. So now we get to sort of the challenge part of the discussion, which is why we're all here, in that over the last 5 years, many large cap managers have underperformed their respective benchmark with sort of a distressing persistence in the post-financial crash era. Not all, but the majority certainly have. And so that's what prompted this research. And so we did the same analysis for just the post-financial crash period. And you can see that the slope of the line changed, that in fact there was a negative relationship between, or basically a non-existent relationship between active share and excess return and information ratio. So the question is why? What is this? Is this an aberration, or is this a structural change? And so next slide. So what we looked at is to answer that basic question, is this cyclical or structural? We looked at the pattern of relative performance for active managers over almost a 20-year period. And you can see that there is a clear degree of cyclicality in that when periods in which active managers are above, and by the way, the green dots are actually the benchmark. And so whenever the green dots are above the median manager, it means that most managers are underperforming and vice versa. So you can see that, when the benchmark lives above the median manager, it's then followed by living below the median manager, and that the period is about 5 to 6 years. You can also see that during intense market downturns, that's actually when you need active managers the most, and that in effect protect the assets of your fund. And then finally, you can see that the current cycle, where in essence the benchmark is in the first, if the benchmark were a manager, it would be in the first quartile, and that has persisted for about 4 or 5 years. So finally, in the next slide, the question is kind of what the key for us anyway was to determine what drove that cyclicality. And so what we did was use the rank of the benchmark as a dependent variable, or the thing we wanted to explain, if you will, in a series of regression analysis. We looked at about 16 variables, 8 of which were significant, and in the interest of time, I'll only discuss 3. So you'll see one variable that drove the relative underperformance of active managers was the intensity and scope of monetary easing. Over the 20-year study period, monetary easing was actually supportive of active manager. Over this particular, in the post-crash period, it had the opposite effect. And maybe later on we can talk about why. By far, though, the largest variable was stock correlations. In fact, which is never good for active managers, because obviously if their job is to differentiate, if everything is moving in synchronicity, there's no ability to differentiate. But you can see that stock correlations increase the impact of it, the negative impact increased about 9 times during the post-crash period. And finally, the third most important was the level of stock return dispersion, meaning what is the difference, the performance difference between the winning stocks within a market opportunity set and the losing stocks. And that is not a great thing for active managers in upward momentum market, and that particular variable increased by 3.5%. The good news, which is what I'll end with, is that we track correlations daily correlations in various markets on a weekly basis. So to the right is the correlation of the Russell 1000 index as of the end of May, and you can see a sharp drop in correlations in the first quarter of 2013. I note in the read-in material provided by your staff that the return of your active portfolio actually markedly improved in the first quarter of 2013. So it may or may not have something to do with that. I'll just close by saying that to the extent that that normalizes, that I think that cycle that we observed earlier will improve. But I will also say that what our study showed that we found far more alpha persistence among small cap managers and non-U.S. strategies that were less susceptible to changes, deleterious changes in the structure of the market or in the macro regime. So with that, I will